Good morning. This is Dave Toth with an RJO MRT Technical Webcast update on the S&P 500 E-mini, the Mini Russell 2000, and the 10-year T-note markets for Wednesday, April 20th. Starting off here with an intraday 4-hourly chart of the June S&P contract, you can see yesterday's and overnight's sharp impulsive recovery above Friday's 13.19 and a quarter high. We needed this market to recover above to arrest the prior week and a half sell-off and expose whatever low was rejected as the low or lower boundary to a three-wave, and thus potentially a bull market corrective sequence ahead of a possible resumption of the secular bull trend. By virtue of this recovery, the most important byproduct of this recovery is the definition of Monday's 12.90 and a quarter low as the end of at least this past week and a half sell-off that, again, from our Elliott wave labeling, looks to be a three-wave sequence that, left unaltered by new lows below 12.90, defines that 12.90 and a quarter low as the end or lower boundary of a broader bull market corrective sequence ahead of a resumption of the secular bull trend. On a daily log scale chart shown here, this is a linear scale chart. The interesting combination of this week's sharp recovery from the 50% retrace area of March-April's 1241 to 1336 rally reinforces the prospect that this month's setback attempt is a intermediate term degree, a part of an intermediate term degree bull market corrective sequence that ultimately we expect to yield new highs, not just above the April high at 1336, but the February 18th high at 1343. Of course, the market remains below these two prior resistance levels, so we must remain diligent with respect to getting too aggressive in a bullish policy at this point, because the market could very easily remain in this month's range between 1336 and 1290, but the important thing about the past day and a half's sharp recovery is that the market has arrested the prospect or mitigated the prospect of a much steeper correction lower by virtue of this week's early break below last week's 12.98 and a quarter low that confirmed at least the intermediate term trend is down. The market has been saved from that more steeper correction lower and has defined the 1290 level now as the key risk parameter. This market is required to fail below to resurrect a wave count calling for a much larger degree correction or reversal lower. In sum, traders are advised to move back to a neutral to cautiously bullish policy, with weakness below 1290 now required to warrant moving to a neutral sideline position in order to circumvent the depths unknown to a larger degree correction or reversal lower. As long as the market remains above 1290, the directional scales are now tipped back in favor of the long-term bull to eventually new highs above that major 1343 high from February 18th. But again, we would remind traders of the interim caveat that while the recent resistant highs at 1336 and 1343 remain intact, it would be premature to move to a more aggressive bullish position because that resistance unbroken could provide more lateral price action in the weeks ahead. Similarly, looking at an intraday 4-hourly chart of the Jun Mini-Russell contract, you can see overnight's recovery above Monday's 83.45 high that confirms at least the intermediate term trend is up. That said, however, the fact that the market remains below the April 6th high at 85.81 maintains the possibility that the initial sell-off to the 81.34 low from last week is just the A wave or first wave of a larger degree consolidation or reversal lower. Indeed, the market is barely back to the middle of this recent range, and while clearly the short to intermediate term trend is up and the market has defined the 81.34 low or reinforced the 81.34 low from last week as a key support and risk parameter, the market's now required to break to resurrect a larger degree correction or reversal lower. By the same token, as long as the market remains below that key 85.81 high from early April, the prospect remains that this market could just be oscillating in a larger degree but now lateral consolidation pattern. This said, we think it's also important that the market's recovering from the 50% retracement of March-April's 77.02 to 85.81 rally. That, within the context of the secular bull trend, we think reinforces the developing prospect that this April low thus far at 81.34 is going to define the end or lower boundary of simply another bull market corrective stair step ahead of a resumption of that secular bull trend to new highs above 85.81. These issues considered, traders are advised to move back to a neutral to cautiously bullish policy with a break below 81.34 required to negate that specific view and resurrect a larger degree correction or reversal lower. As long as the market remains above 81.34, further and possibly accelerated gains should not surprise, with, of course, that 85.81 resistant high from April 6th, the key upside threshold this market now needs to break to reaffirm the secular bull trend. And finally, moving to a very interesting development in the 10-year market, and that is maintaining its inverse correlation of late with the equity indices. You can see that by virtue of overnight's break below the 119.27 corrective low from yesterday, the market has confirmed a bearish divergence in short-term momentum. Now, relative to the past week and a half's fairly nice recovery, it's questionable as to whether we should conclude a larger degree reversal lower simply based on this very short-term bearish divergence in momentum. But the fact that this momentum divergence is combined with the market's rejection, thus far at least, of the exact 61.8% retrace of the March-April decline, we think reinforces not only the prospect that this market is heading lower, but reinforces our long-term bearish prospect that on the heels of the February-March three-wave bear market correction and the subsequent March-April sell-off, that this month's recovery attempt is merely a B or second wave correction within a much broader bearish count that ultimately could produce new lows below that February low at 116.03. These issues considered, traders are advised to move back to a neutral to cautiously bearish policy at the market. We think this combination of the 618 retrace and this short-term bearish divergence of momentum provides an acute, favorable risk-reward opportunity from the sell side. We'll follow this up later today with a specific trade recommendation to establish bearish exposure with now strength above at least the 120.12 level required to defer it enough to warrant moving to a neutral sideline position. Of course, from a long-term perspective, we still require strength above the 121.26.5 high from March 16th to negate our longer-term bearish policy. But again, from a very short-term perspective, short to intermediate term perspective, we think an acute risk-reward selling opportunity has developed as a result of this combination of a bearish divergence in short-term momentum and that 618 retrace that defines the 120.11 high from yesterday as one of developing importance and quite possibly the start of the resumption of a bear trend that could be significant in its scope in the weeks and perhaps even months ahead. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.